Well, hello, folks. For the last couple of weeks, we've been discussing the importance of tax diversification when it comes time to retirement planning. Now, let's face it, we have to understand taxes, and taxes in retirement is an expense, and for many is a very large expense. Now, this is an expense that drains your accounts faster because in order for you to generate the income that you need, what has to happen is that you have to take out more to compensate for the taxes that you pay. Now, in doing that, what happens is that this taxable income now causes your Social Security to be taxed, and quite often it has the possibility of throwing you into another tax bracket. Now, as I stated before, most people have their assets in tax-deferred investments. For an example of this is your employer plans and your traditional IRAs. But today I want to talk to you about tax-free investing. Now, there are all sorts of investment vehicles that masquerade themselves as tax-free, but what I'm talking about is truly tax-free. For example, one of the things that a lot of people think about is municipals. Well, municipals have problems because municipals have state tax sometimes that are an issue with municipals. Municipals have capital gains that are also an issue with municipals. And one of the things about municipals is that the income derived from municipals goes towards the calculation of how much your Social Security is being taxed. And when I talk about totally tax-free, I mean one thing, totally tax-free. Now, there are two investment vehicles that are totally tax-free, and that is your Roth IRAs and a properly structured life insurance policy with cash value. Those are the only two investment vehicles that are totally tax-free. Now, who uses one and who uses the other and which one is better is dependent on your situation and what you're trying to accomplish and your circumstances. But I'll tell you this, one has more limits than the other. For example, the Roth has a lot of limitations. It has contribution limits, it has income limits, and you still have to wait till age 59 and a half to generate that income, even though it's tax-free. Now, structured life insurance policy, one that is structured for retirement planning and tax-free income, is very flexible. It has no contribution limits and no income limits. Again, but the objective of both is still the same. They provide a totally tax-free income at retirement. Now, with all that's being said, it's important to understand there is no perfect plan. Any plan has its positives and negatives, and although I can illustrate them to you and Excel spreadsheet you to death, we don't live in an Excel spreadsheet. There are many variables usually around us that we need to take into account, and that is why it's important to balance out how we use these vehicles now and into the future and take into account carefully the consideration of the effects of income and taxes into the future. Now, we also, at retirement, need to get rid of the fallacy that, well, I'm paying higher taxes because I'm making more money. Well, listen, that's not always exactly true. One of the things to understand that usually at retirement, you're paying more money because you have less deductions to take into account to lower your taxable income. So it's safe to say that quite often at retirement, your taxes that you're paying are voluntary because it's dependent on how much time you planned early on how you were going to generate that income at retirement. The better you do at planning, especially in the early years as you get into retirement, and especially how to balance out these investment vehicles or these taxable vehicles, it will determine the taxes that you will pay at retirement. So with that being said, call me with any questions, and I'll see you in the next episode of Financial QB TV.